remember it's general advice only. General advice only. So we do encourage you to seek independent advice outside of tonight's session, so that you can have your personal circumstances taken into account. And Mark and I would be more than happy to provide that independent advice, taking into account your individual circumstances as well.
Okay, and so Michael, you're seeing your slides up now as well.
Yeah, I can. Yeah, I can see those slides on the screen.
Excellent.
Perfect.
I've just got Pat calling now. I'll just be a second.
If you haven't already grabbed a cup of tea or something, actually, Pat's here. So Pat's our host.
Good on you guys. I guess it serves me right for having this fancy setup here that we hit the webinar button and it sort of reset itself.
We're
So
all together.
you've been chatting to everybody. Oh, good on you guys. Thank you. Well, I guess I'll start with an official welcome. I know you have been talking to our audience, so thanks for your patience if you've been there waiting for us. It's nice to see a few people joining and being patient. This is the studios of Tell Your Story Media. My name is Pat Panetta. I'm a radio presenter, and I'm the founder of this Tell Your Story Media content studio here, podcast studio that you see here as we go live around the internet. So you're going to learn something, we hope you are anyway, something special today. The name of the webinar and the live stream, Renting to Owning, Melbourne First Home Buyer Webinar. So great to have you here. So thank you so much. Your understanding of how much you can borrow, how to leverage the current market opportunities. We're going to help you build your wealth via property. At the very least, go from renting into your own home. So here we go. Now I know you've met our special guests already while I was setting myself up here, but that's Mark Errichiello that you'll see on the screen,
Hello.
and also from Master Advocates, and Michael Sue, mortgage broker from Mortgage from First Choice. And yeah,
Mortgage choice.
mortgage choice.
Similar.
And these guys, I know we've done work before, haven't we? You know your stuff, that's for sure. So you're about to share some of that information now. But you've said hello to everybody, have you already, boys, and sort of kept them all warm for me?
Briefly,
Yeah, we have.
Okay, so let's start with a market wrap with you, Mark, as far as Melbourne's property market goes. The suburbs that offer value, and if you're thinking about taking advantage of the current market, the opportunities of the government, what suburbs in market in Melbourne should you be thinking about?
Yeah, certainly. Thanks, Pat. It's a good question. And also, as Michael said earlier, it's general advice, but we're both available to, I'm sure Michael's happy to share slides as well. I'm happy to share notes or give it, general advice off air also. But we're seeing some strong growth in the September quarter in the Melbourne market, mainly for houses and townhouses and well located units also, mostly within the 30 kilometre radius of the CBD in the metro areas, and most first home buyers that we find purchasing between say 500,000 up to that $950,000 bracket will seek properties. Most value we're finding within that northern and western pockets, 10 to 30 kilometre radius in suburbs such as inside the Western Ring Road from Sunshine West, following through to northern pockets of Glenroy, Hadfield, right through to north and northeast edges of Bundoora, and then travelling outside the M80 Western Ring Road if they're needing larger properties for their budget as well, but usually following train lines and main principal infrastructure, principal transport to get best value. And I find that we're in a pocket now of growth and on track for a good December quarter as well. There was close to 2.9% growth for the well established properties and suburbs in the September quarter, and you've had a lot of soft pockets in the market over the last 2 years, especially in Victoria. You've had interest rate rises nationally, but then affected with extra regulations, extra taxes in Victoria, global factors that affect the market sentiment. And right now, this year, we've had 3 interest rate cuts, and the sentiment with the first home buyer incentives that have improved, that Michael will elaborate on, since the 1st of October. it's providing opportunity for this first wave of people that are first home buyers that are purchasing, but opportunity and right pockets will still be there if you plan well, do your due diligence, and it's certainly looking pretty strong for the next 6 months. But you don't want to wait for the planning period.
Well, waiting, we can talk about that too, because you could be waiting forever. If it's your time to go, you should do that, but we can talk about that. But so if you're a first home buyer as well and you really are keen on a suburb, you want to live in a city or you have a lifestyle in mind, should you be stuck to that, or should you really be saying to yourself, okay, that's where I need to go and that's what I need to work out? Or should you be thinking about, okay, I'll go a little bit out of the city and maybe just, weigh up my options?
Yeah, look, it's a good point because sometimes you've got a certain lifestyle or access to employment or schools and other or family. But yes, I certainly agree. If you can explore a little bit further, especially if we're talking in the context of Melbourne, we've got some good infrastructure, some good transport. The work from home options are there as well for many. If you can explore, say, if your budget was 5 or 6 or 700,000, and right in the inner city, inner metro, that may get you a small 2-bedroom villa unit or an apartment, depending on age and condition. But you travel out a few kilometres on the same train line or same tram lines, and you might be able to get a slightly better asset, a bit more land ratio, a bit more land to asset ratio, a better quality property or size footprint. You're then thinking like an investor. It is your first home, but you want to leverage from it. You don't want to go backwards in 10 years' time. You want to have a capacity to get some equity, get some growth. You may move out and rent it. It may be your first investment. So certainly think outside the square there. Don't limit yourself to your favourite suburbs.
Now, the good bit here, it's really getting into financing your purchase, which is exciting, Michael. I know you deal with people when you work out how much you can, get to purchase a home. That's the first step to that exciting, thing about changing your life and getting into your own home. So, how to make the most of the government schemes and low deposit options, Michael? You've got a wonderful presentation. So, Michael Sue from Mortgage Choice, over to you.
All right, no, thanks, Pat. Well, before we dive into it, I just wanted to share with everybody why I'm so passionate about helping people get into their first home. So before I became a broker, I worked in the super and retirement industry, where I did a lot of research, interviewing pre-retirees and retirees, holding focus groups and that sort of thing. And what really came clear to me out of that research was that the biggest determinant of the quality of life that a person leads in retirement is actually whether they own their own home. And when you think about it, that kind of makes sense because if you're renting when you're in retirement, a lot of your retirement savings is going to be eaten up by rent. You're also at the mercy of the property owner because they could take that property back at any time because they want to sell, they want to renovate,
Yes.
right? Or you can no longer afford the rent, so you don't have that certainty. So you're having to find a place from period to period. On the flip side of that, if you own your own home, you have flexibility and optionality because then you could rent out a room to, generate a bit of pocket money to spend. And also importantly, if you own your own home, if you live in your own home, then that home is exempt from the assets test for age pension purposes. And so that gives you further options to generate income as well and having that asset there. Right. So this is why we're so passionate about it. And so this is
Yes.
really the genesis of wanting to hold this webinar. So Mark and I really wanted to educate people about the ability to purchase their first home, because I know there's a lot of negative headlines out there in the marketplace. It's all doom and gloom, prices are sky high and so forth. But the reality is that there are options to people. And then what we want to do today is show them how we can make it reality. And so really it's around how we can buy now, not later, as you can see on the screen today. And as you mentioned, Pat, what I'll talk about is around the government schemes that are available to people to support first home buyers, both at the federal and also state levels. What are some of the low deposit options that people have if you don't have much of a deposit? And also then how do banks think about borrowing, working out borrowing power, borrowing capacity, and also try and demystify some of the things that you read about how help debt can impact your borrowing power. So they're the three topics I want to talk about. So
Yep.
maybe if we could move to the next slide, Mark. So the
And
biggest roadblock.
yep.
The
Going to
biggest,
say, well said
yeah,
there, Michael. You know, when, as you say, you just to hear you say that, the benefits of owning your own home are so strong, as you've said out there. Don't hold back, because it can be a bit daunting to go down this road, but there is real value into taking the first step. So anyway, sorry, Michael. Yep.
That's a
no,
good
no,
point.
exactly right. That's right, Pat. And I think you're right around people often feel daunted, don't know where to start, but that's why there's people out there that you can speak to.
Mm.
And that's where then they can make it easier, breaking it down to smaller steps for you to understand what the processes are. And then when you hear those sort of things, then you can start planning for it, and then it becomes feels like it can become reality.
100%. Okay.
And often that first reason why there's that hesitancy is, and the biggest roadblock, as you can see, is actually trying to save for that deposit. So if we go to the next slide, Mark, the deposit that you need is generally around 20%. Okay. Now, 20% deposit, if you're looking at a Melbourne, the median price Melbourne apartment or unit, it's around $650,000. So you're looking for a deposit of about 130,000. A house is around 950, so that's nearly $200,000. And so you can see why it would be so hard to save for that 20% deposit, because if you're paying rent, it's like going two steps forward, two steps back, and you've got the cost of living pressures and so forth. And then if you don't have that 20% deposit, then that leads into lender's mortgage insurance. Now, lender's mortgage insurance is insurance that protects the lender in case the borrower defaults. Now, ordinarily with insurance, if you take out car insurance, home and contents insurance, life insurance, you pay for that, but it's benefiting you, it's to protect you. The annoying thing about lender's mortgage insurance is that it protects the lender and you're paying for it. So you're paying to protect the lender, and that cost can be in the tens of thousands of dollars. And so it's really prohibitive. And so it makes it just doubly hard, because if you don't have the deposit, plus you're paying lender's mortgage insurance, you can see why people get stuck. So the government's recognised this, and Mark's mentioned it at the outset around the government home guarantee schemes. Now, if we turn to the next slide, now this is at the federal level. The government's recognised that people are struggling with the deposit, so they've made it easier for people to purchase with a lower deposit. So, Mark, if we move to the next slide. Now, it's been in the papers a lot recently, particularly since 1 October. Now, the reason for that is this scheme has actually been in place since 2020, so it's not new. But what's changed is that before there were a limited number of spots, now it's open to there's an unlimited number of spots. Before it was means tested, so you had to be below a certain income threshold to qualify, whether you were a single or a couple. But now that's been removed, so you could be earning $200,000, $300,000, $400,000, and you could potentially participate in these schemes. And then the third part was around the property price caps. So they increased those. And I'll talk a little bit about price caps on the next slide. But for all intents and purposes, there's two deposit schemes. One at the 5% deposit scheme. Now it's a minimum of 5%. So the expectation is if you have more than 5% to contribute to the purchase, that you would do that, but on the understanding that you could save, you could retain a reasonable amount of savings, say around $30,000. Now it's open to first home buyers, but you have to be living in the property, and you can't have owned a home in the last 10 years. And this is where potentially it can trip some people up, because if they've inherited an interest in a property, just say there's four family members and they've inherited a property from a father or a mother, and they each have 25% interest, and then they sell it, that would still count and that would disqualify them. Okay.
Mm.
On the, you going, Pat?
Oh, that's interesting. The last 10 years. So I'm thinking
Yeah.
first home buyers, but also if it's been 10 years since you've purchased a property, you're also in the game for these sorts of benefits.
Yeah, that's right. As long as you don't, even though you may have purchased it more than 10 years ago, you can't own it right now. But if
Yes.
you'd sold it back then, yeah, you could participate in this scheme.
Okay.
Which opens up the competition group of buyers as well.
Yeah, that's right. So older demographic potentially.
Gotcha. Yes, yes,
Yep.
yes, yes. Understood. Okay, no worries. Well, yeah, keep going there. So we're evaluating how we can leverage these opportunities, these government schemes there, Michael.
And then just lastly, with this government scheme, the 2% deposit scheme for single parents, so a single parent with a child, and similarly, you have to be an owner occupier. You have to be living in the property. Here, it doesn't have to be your first home. but you just can't own another property right now. So you could have owned one 6 months ago, had to sell because of a divorce or for whatever other reason. Don't own something now, but this gives you a chance to get back into the market with 2%. And so the beauty of both these schemes is that it's low deposit requirements and there's no lender's mortgage insurance.
Geez. Oh, that's good, Mark. Isn't that good? Low deposit and no
Yeah.
lender's insurance. So there's
Well,
some real opportunity there.
and there are quite a few families in that position, especially
Yeah.
post COVID and issues with separations, people getting back on track.
Yep.
That last point probably will open up some benefits for some families.
Yep. And you're saving a chunk of money there on the insurance, as you say. And normally the deposit, did you say, was 20% there, Michael? So you're down
Yeah,
to
that's right.
5% or 2%. Okay. Opportunity.
Yeah.
Knocking for sure.
There are some limitations, and we'll go to the next slide as well, some further limitations, and that's the property price cap. So you need to be purchasing to qualify a property that's underneath these prices that you can see on the screen here, in particular in relation to Victoria. So Melbourne's at 950, Geelong's at 950, and anything outside of those two cities, it's at 650. And interesting here, you can see Queensland actually has priced, their price cap is higher than Victoria, which you wouldn't have thought of 2, 3, 4 years ago. But what's that a reflection of is actually a lot of interstate migration from Victoria and New South Wales, where historically property prices were higher than Queensland.
Yeah,
So,
definitely. And you're seeing that rapid growth even out of the city, 10, 20 kilometres out, where you speak to interstate colleagues, they're finding that growth opportunity of what you can buy. It's getting more difficult.
yeah,
And
correct.
950,000 and the $1 million in Queensland, you can get a good property at, that's nothing to be sneezed at. You can get a good property keeping those caps in mind, can't you, Mark?
Yeah, well, that's what I was referencing. So, we specialise in Melbourne, Metro, Victoria, but we've got affiliates and colleagues interstate that we do talk to regularly, and even that inner 10-kilometre radius, it's still not that many great opportunities, under $1 million now because of the rapid growth they've had. But there are still pockets that 10 to 20 kilometres out of the city. And when we talk about assets later and types of assets, without getting too off track from Michael's current slide, then yes, you can always buy property, but if it's the right asset for long-term, growth and benefit, that's the harder part to pick, within particular budgets.
Yeah, that's right.
Michael? Over
Yeah,
to you,
so,
Michael.
yeah, so next slide here. So this is federal government schemes. Now, at the state level, they've also come to the party next slide here, Mark, so that at the state level, they'll also come to the party to help first home buyers who are looking to live in the property. So you can see here Victoria and the first home owners grant in that middle column there for new homes. People can get a grant of $10,000 for homes under $750,000. And also there's stamp duty relief. So you're fully exempt from stamp duty if the price is under $600,000. So that's saving about $30,000. And then between 6 to 750, it tapers off. You still get a discount, but it goes down to nil at 750. Now these state government schemes also complement the 5% federal government 5% deposit scheme. But you just need to be mindful of that if you're purchasing a property above 750, you might qualify for the 5% deposit scheme, but you're going to miss out on the stamp duty exemption.
Right.
Yeah,
Okay.
and it's a good point, and sort of, I guess from an advocate point of view, it depends on if that's your limited budget, then go for all the incentives you have. But if you've got the capability of, say, going over 650 or over 750 to get a house or a better asset for growth and all the good key metrics, get it now, because in time, in a decade, there's going to be capital growth, and that's always going to outweigh the initial tax savings of stamp duty. If you can, not everyone's in that position. People are under pressure, but that's probably the only point I always share there.
Okay. So opportunities with federal and state government. So there's a few options to be weighed up there.
Yeah, exactly. And so when you bring it all together, if we go to the next slide,
It's a bit slow. There it goes.
no, that's right. So when you combine the two schemes together, the state and the federal, buying your first home got a whole lot easier. So I use the example here, a median priced Melbourne unit or apartment around 645,000. And Mark, to give the viewers an idea of what you could buy for 645 in Melbourne.
Yeah. Look, and when we talk about median data and broad data across the state, that does include apartments and sort of units, townhouses, or your traditional units and townhouses. Then you've got the housing data, but 645,000. You go in the northwest, especially. There's probably some colleagues online that would mention the eastern suburbs or Bayside. You're probably only getting apartments, and boutique apartments are better. I'll go on that detail later, but you don't want too high density. In the city, you can still get low-rise apartments in the inner 10-kilometre radius. Some key suburbs like even around Flemington, Ascot Vale, Moonee Ponds, Essendon. 2 bedrooms in the 500,000 range, and then going out to suburbs like Pascoe Vale, just that 10 to 15 kilometre radius from the city, you'll get villa units, which are you're generally single level, 2 bedroom, and they're starting to get competitive in that price range, and there'll be growth by next year. I strongly feel that within the next 1 to 2 years there'll be less opportunities in that price range, but they still do exist, and it's more about picking the pockets and the opportunities at the moment.
Yeah, and so that's why I think what we're saying here is, if you've got the ability to make a move now, use that opportunity. Don't wait. And because you can see here that it's a massive difference. Without the scheme, you'd need 160,000 to upfront in terms of funds, but with the scheme, it's 42,000. So it's $120,000 less upfront that's required, and so that pretty much takes away probably 4 or 5 years worth of having to save to get into the market now.
Yeah, right.
It's good. Wow. It's good to put it in that context of the time of saving, because 4 or 5 years from now, when we're into this growth cycle, not to scare people, but if you've got capabilities of getting out of the rental market, if that's your position right now, and buying, it's the timing's there where you can get some growth.
That's right. So these are the government schemes. So what happens if you don't qualify for the government schemes, or you're wanting to look at other options that are available to you if you've got a smaller deposit? So when we go to the next slide, so something in the next slide after that. So some lenders, right, have some really generous policies for certain professions. So if you work as a health professional, doctor, nurse, dentist, pharmacist, radiologist, radiographer, physiotherapist, and so forth, or an accountant or a lawyer working as an accountant, a CPA or a chartered accountant, and also as a lawyer. Then
Presenter?
Radiographer, radiologist,
maybe
close.
Radiologist.
Yeah, maybe that's what we should call it.
Just to try.
Yeah.
Okay, anyway.
So you could purchase with a minimum of 5 to 10% deposit, no lender's mortgage insurance. And here, this is where the flexibility is. You don't have to live in the property. I mean, you can live in the property, or it can be you can be an investment. It's not limited to your first home or a single home. It could be multiple homes. So there's greater flexibility under these policies that these lenders offer.
Yep.
That's a good
It's a nice one.
And
that's probably
so then you might satisfy some of the first home buyer incentive requirements, and then rent vest or turn it into an investment completely.
Yeah, that's right. Right. Yeah.
The 5% deposit or minimum, or to 10%. So whatever you're purchasing, you just got to save up that deposit and off you go type thing. What do you think, Boyd?
Yeah. No, that's it. And so the question is, what happens if I'm not a health professional, or I'm not an accountant, and I'm not a lawyer?
Okay.
What about me type thing? Well, next slide. There's been a new product launched by one of the major banks. It's absolutely a brilliant offering. It's a 10% deposit product as well. No lender's mortgage insurance. It's open to anybody, investor, owner, occupiers, and not just first home buyers. So it's basically broadening the universe of people who can buy with a low deposit and no lender's mortgage insurance. So there's a wide range of options available to people through the government schemes, through the specific lender policies targeting certain professions, and now with this product. And this was only launched a couple of weeks ago as well. So it's a bit of a game changer.
It's good.
And that's why I know we're going to get there, and we've said this already, to use an expert. As I see all this, okay, lots of opportunities, and we're talking federal, state government, there's new products that the banks are talking about. So sit down, and I mean, there's this webinar to help you too, and we're still going to go through how the banks evaluate what you can purchase or what you can borrow. But that's the idea. Sit down, lay all your cards on the table, and work out what you can use to get your home and get going.
Yeah, That's a good point, Pat, because this is sort of general in nature, but seeking out a mortgage broker and consultants to get that roadmap for you personally and see what
Yep.
you're capable of achieving. And Michael, if someone is renting right now and looking to buy, their rent gets taken into serviceability calculations as well, like the capability of lending.
Yeah, it does, and that's probably a good segue into the next part where because everything we focused on at the moment is the deposit. What is it that we need to? What are the banks take into account to work out your borrowing power? And rent's definitely one of those
Good.
Right.
as well, which is then often the comment, well, why borrowers can potentially struggle because they've got rent, but then if they're going to purchase, that rental
Stops.
stops. That's right, that rent stops and it gets
Yes.
replaced with the mortgage. But we'll come to that in a minute. But with the borrowing power, so if we could go to the next slide. So we've talked about the deposit. The other part of the equation when you're looking to purchase is actually how much can you borrow. So essentially, it's a pretty straightforward formula in the sense that the banks will look at your income and then what expenses and other commitments that you need to make from a month-to-month basis. And then they look at what's remaining to be able to meet the monthly loan repayments when you take out the mortgage. A couple of things I wanted to highlight here with expenses. So that's just your basic daily living expenses like your groceries, recreation and entertainment subscriptions that you might have, insurance, medical bills, school fees, childcare, and so forth. Where the area people do get tripped up though is with credit cards. So I know a lot of people like to collect credit cards because they want to accumulate rewards points or they get the cashback bonuses. And they say to me, well, I pay it off. I don't really use it. I pay it off every month. Just sits in the bottom drawer. I'll use it when I go overseas, to pay for overseas purchases. It doesn't matter. What the banks look at are the credit limits. So if you've got a credit limit of $10,000, they apply an interest rate of 3.8% per month.
Yeah.
So that's 10,000 times 3.8 is 380. If you've got three of those cards at 10,000 each, 30,000, that's over $1,000 of monthly repayments just from the credit card. So it's like a mortgage repayment payment in itself.
Yes.
If you've got buy now, pay later, same deal.
Right. So
So
you
So
should
it's
be you should be
always the
cutting
credit
up.
limit.
Is that right?
Sorry,
Yeah. Okay.
sorry,
That'll
mate.
be.
Go
No, I'm
ahead.
with you. Yeah, exactly. It's always the credit limit, as you say. It's in the bottom
yeah,
drawer. I've got it there for a rainy day, but the banks are looking at the
yeah.
credit limit and calculating the interest. So are you cutting them up, boys? Are you basically saying, well, I've got to get rid of the credit cards before I come and see Michael Sue and Mark Errichiello? Or
It's a good idea, isn't it, Michael? If you don't have, if the limit's just sitting there and you're not
Yeah.
owing money to pay out the balance, does it still count if someone closes the card and organises a payment to pay out the balance with the bank? Do they still look at that if they're paying out the balance only but haven't got a facility to draw credit on?
Yeah, so if they've paid it out, closed it down, yeah, so that's all good then.
Yeah.
And the bank doesn't take that into account. Or if you really think you do need it because you've got all your direct debits linked to it, then just try and reduce the limit. And it also depends on your borrowing capacity. If you've got plenty of borrowing power and it makes no difference, then that's fine.
okay.
But it's really that's why it's the sort of needing to work with somebody who
Yes.
understands the nuances and how the different policies work at the different banks to
Yes.
make sure that you maximize what you need for the purchase that you're looking for.
That's part
Tax
of the
debt.
preparation, getting a consultation,
Correct.
help you get prepared in advance.
Yeah,
Yes.
correct.
So it might not be a problem with the credit cards. It's about your borrowing power. What about tax debt? I've written out here tax debt, school fees, these sorts of things. Again, they're the
Yeah.
nuances that you need to look at.
Yeah, that's right. Yeah, tax debt, school fees, private school fees. Yeah, they all hurt in terms of your ability to borrow.
Yeah.
Yeah, so that's yeah, definitely. And the other one is the help debt, and I'll come to that on another slide because there's always a lot of bit of confusion, around how help debt, hex debt impacts your borrowing power. And then the last part then is with the loan itself and the way they calculate the monthly repayments, they don't look at the interest rate that you'll be paying. Just say your interest rate is 5.5%, they add 3% to it. So they look at the repayments if the interest rate was at 8.5%. So they're adopting a level of conservatism to protect themselves, but also gives you a level of comfort. If they're giving you a loan, right, then you should have comfort that if the rates do go up to 8.5 in this scenario, that you'll be able to meet those repayments. Because the banks, whilst you've got all these government guarantee schemes, they still need to be able to lend to you responsibly to make sure that you don't get yourself into financial difficulty when you take out this loan.
Yes. What if you own a big dog that barks a lot named Is it strudel or
She
poodle?
was in the
And
practice room,
eats lots
wasn't
of
she?
food. But if
Yeah.
you're rich, it's okay.
Well,
You can.
she eats a few kilos of meat a
Yeah,
day,
yeah, yeah.
50
Well,
That
yeah.
might
kilos.
impact your borrowing power if you
So I
Get rid of
buy
the
it all.
dog.
It's all in cash. The meat. It's a
cash.
fine.
Wait,
Yeah,
what have
no
you
one
done
can
with the
trust
dog?
her.
During the rehearsal, it was barking in the background
She's
there, Mark.
she's taken a sedative and
She's
she's resting.
asleep.
Yeah.
All
Well,
right.
hopefully I haven't put it to sleep.
No, no.
It's not you, Michael.
Yeah, I
Um,
hope so.
all right.
All right, we'll quickly
Okay.
move on just to help
Yes.
debt. Yep. Okay, so help debt, there's a lot of confusion around how it impacts borrowing power. It's two factors. The main one is help repayments, right? So the monthly repayments on the help debt. This is an interesting thing. Help repayments are based on your income level. So if you've got two people both earning $100,000, one who has help debt at $50,000, another one has help debt at $80,000, that help debt balance doesn't matter. They're affected the same way with their borrowing power because their repayments are the same because they're both earning $100,000. So in that case, debt balance doesn't matter. Okay.
Mm,
Where it may come into it is this thing called, you can see number two here, debt to income ratio, because generally banks look at the most amount of debt that they're willing to allow you to have, and it's around that 6 to 8 times annual income. So just say you have an annual income of $100,000, you've got credit card limits, personal loan, and the mortgage itself. If that, when they add that all up, it can't be more than the 8 times 100, which is the $800,000. In my experience, the help debt balance doesn't really come into it because your borrowing power is significantly less than your overall cap. To give you an example, if you've got a couple both earning $100,000, okay, so $200,000, and the cap is 8 times annual income, that's 1.6 million. Their borrowing power, with that formula we looked on the previous slide, after taking into account all your expenses, maybe they could only borrow, say, $600,000, and their help debt was 650 relative to 1.6. They're well under that total cap.
So fairly
So,
safe going to
yeah,
them.
that's right. So it makes no difference. It's
Yeah.
really the repayments that makes the difference. But that said, some lenders do have really flexible policies around that. So if it looks like you'll have all your help debt paid off within 1 year, they can just disregard the repayments. So that will help with your borrowing power. Or you could think strategically, just say you're looking to buy under the 5% deposit scheme. Actually got a 10% deposit. You might look to use some of that savings rather than putting it into the purchase to pay off your help debt. Say you had 10,000 help debt, paying off the 10 could actually give you an extra 50,000 in borrowing power. And that could mean the difference between an investment grade property and one that's maybe, a bit iffy.
Something that will serve you if you hold it,
Yeah.
because we always say buy and hold.
Yes.
You profit when you buy. So we've got the
Yes.
capital growth to come.
Yeah.
Choose the right asset, and then when you were talking about retirement earlier, and that's the asset that you hold. Then if it's your own home,
Yes.
that's probably the most important time. The decisions you make now.
No, exactly. That's right. And so we've talked about the deposits, the borrowing powers, and that's how, bring it all together. That's what you can use to make a purchase. But what I've found time and time again is that people really worry about the commitment. They say, oh, I don't want to be tied down by a mortgage. But then again, you've got rent that you're paying. Okay.
yeah.
And so if we
And
go to the next slide,
increasing as well.
that's right, it's
Rental
increasing.
market.
And if we go to the next slide, so what's happening then, if you go to the next slide, Mark,
Yes.
if you're renting, what you're doing is building your landlord's wealth, not yours. And whilst it may feel like, a bit of a pain to pay the mortgage, right? But really what it is, you're building up your own wealth. You're saving for your future. So if you look at the rent there for taking that $645,000 property we talked about, the median price, the rent, 600 a week, is about 2,600 a month, you're building no equity. Whereas if you're purchasing that property, the monthly repayments would be about 3,600. If the property grows at 5% and you are picking a top quality product home because you've got Mark supporting you to help make sure that you make the right decisions, that will grow at 5%, and that's sometimes that can be pretty conservative. That's $32,000 in wealth, and that will compound over time. Now, Mark, if you go to the next slide.
Yes.
No, I'm not saying that will be increasing at a straight line. You can see here, this chart here is the median value increase in properties over a long, long time, going back to the mid 1980s across the main capital cities. You see, there are the ups and downs. There's some flat periods, but you can see the general direction is up.
Even
This
if
is
it's
what I mean.
conservative at 5% now,
Yeah.
that the market's improving, that's fairly conservative.
It is, isn't it? And particularly in that price point you were talking about between the 5 and the 900 mark, within that sweet spot for investors and first home buyers. And so this is why I encourage my clients and people that I speak to, friends and family, that if you have the opportunity to buy, just do it. Because if you go to the next slide,
And that
the
next one there.
biggest risk I say, oh, that not the one before that.
There we go.
The biggest risk isn't getting in; it's getting left behind. And
Mm.
this really resonates with me. This what I say here, and because I come up with it, but also because I have a really close family friend about 15 years ago that could have purchased a home, an established home, for about I think it was about 450,000. They've got a family of three at that time, or they still have family. They're still a family of three, and the husband and wife. They decided against it. They ummed and ahed, thought, oh, let's just hold off for a little bit. They were renting. They didn't purchase. Today that same home is worth 1.5, and they're
Yeah.
still renting, and the market's just gone too far
Wow.
away from them that because of their situation, they can't afford to get into the market. And that's what I'm saying to people is the biggest risk isn't getting in, it's actually getting left behind.
Yep. And I think many of us consider thicker stories like that. Your family friend, I guess, a bit closer where they were about to do it, then ummed and ahed. But if you think back of the opportunities that you had to take in, yeah, way back then, can you
Yeah.
imagine now? But there's no time like now, as they say as well. You can look back, but now's, it's all you've got. I'm 52, and it's never too late to get moving and straighten things up.
Yeah, I've been in property, or I've shadowed family in property my whole life, but 25 years this year my professional career, and 11 years as an advocate. And over when you look at it long term, like 5, 10, 15, 20 years, there are ups and downs. There's economic factors, lifestyle can have big changes in your life that affect you with certain mortgages or repayments, but over time you're always going to do well with capital growth. Like most past performance doesn't always repeat, but most good, well-placed properties and metro areas, and even some good, well-established regional towns, should get that double growth in a decade. And there's plenty of data to show that. But even if you're looking out on your own, speak to professionals. There's plenty of professionals out there in the mortgage broking space, in the buyer's advocacy space, that consultations are generally free, and they'll give you some criteria health check, like if you're being realistic with your criteria, or giving you some better advice of issues to avoid as well.
That growth, you probably got more of your presentation if you, Michael, but that growth that you talk about, Mark, that double growth in a decade, or that sort of broad statement, are we talking about homes or apartments or
It's
townhouses?
certainly
Or
not
whatever?
apartments. I've never seen apartments, at
Right.
best in a decade, get some growth in the right, like well-established, well-heeled suburbs might get some growth, but never double. At best, they'll hold value.
Right.
The more boutique, when I say boutique, I mean like less than 10 in a block, well-established, maybe period homes, like
Right.
say apartments in Toorak, for example, or Bayside, where you've got some lifestyle element there, and if it's well built and it's boutique, it's say less than 10 or 20 residents in the block, nice and secure. All of those metrics will help it hold value, maybe get some growth. But when there's a surge in the market, and you hear about 10 or 15 or 20% growth in certain suburbs over time, it's usually houses first, the land component, the land use.
Right.
In the last few years though, townhouses and units have held pretty well, and they do sometimes get the double growth or better in the well located, well established areas, and that's usually within your inner metro. But with apartments, I'd be very careful. Another part to note on apartments, and I've sort of taken bits of my notes and tips at different points and added them in this webinar. But with apartments, if they're high density and they're in activity centres, you may want to do some more research on the housing statements in Victoria and the activity centre growth zones, where planning of current planning schemes that were at, like say 5-storey building capacity, have got thresholds up to 10 and higher levels, and hundreds of apartments. When any builder or developer's building more than 3 levels in Victorian Building Code, they don't need to supply structural warranty insurance when it's 4 levels and above. Right, and there's just more issues when there's higher density. So I always try, if someone's going for an apartment, we don't usually advocate for it, but if that's your budget, if that's the lifestyle choice, location, if that's what you can afford, try to go more boutique. The lower the levels, the less apartments in the block. Even if you've got to spend a bit more, it's got a better chance at holding value and being well maintained by the owners.
Well said. Good on you there,
Yeah.
Mark.
So
Now,
I went on a rant, but
no, that's
ask me
valuable
questions.
information.
Yeah.
Well, that's right. I was keen to know, and I hope some of our viewers can see them online there. We have reminded our viewers, haven't we, that you can contribute through the Q&A box. So any questions coming through we'll get to soon, and I can ask Michael and Mark those questions. But just back to your presentation now there, Michael.
No, I think, Mark, it's probably now that we've talked about the deposit, the borrowing options, and really it's then the client now would be looking to purchase.
Right.
Yes.
What are some of the tips then you'd provide to them as they're looking to, work out what properties are suitable and not suitable?
Yeah, certainly. First, you want to know what purpose do they have. Is it you should never buy for short term, right? And if it's an owner occupied property, but we don't know, if things can change. You might have a 5-year plan and it changes in a year. Life throws you different curveballs. But I like the fact that you pointed out the responsible lending, and where there's the buffer of the 3% lending capacities, all of that. Because some people, they get approval for 500, but just in case don't want to, or say 6 or 7 or 900,000. And there's a lot of competition in that price range. So you need to buy well. You've got downsizers, you've got investors, you've got first home buyers. So looking at your long-term strategy, if you're going to move out of the property after being, say, a first home buyer, you should look to hold the property always in a portfolio, leverage off it. If you can afford to hold it, keep it as an investment. So research the locations. If it's not a location you're familiar with, doing your research on sold results and not looking back at months, even more recent, 3 to 6 weeks is probably more relevant in this market.
I see.
Do the research with the municipality and even state government and federal government infrastructure planning, especially metro. Like when I talked about activity centres before, most activity centres, they're being piloted to have the high density and high development. There's a plan to have it affordable, but if you look at the cost, without going too much into detail, if you look at the cost for developers to acquire land, taxes to build, interest to build, construction costs, all of that, it's hard for them to supply affordable property. Then is the infrastructure going to be improved in that area? Are you going to be overdeveloped, oversupplied, and then the value of your property is going to crush? So that usually, most of those activity centre high-rise and high-density developments, if they do come to play, they're going to be within a 800-metre radius. The zoning will go, say, from 10 levels, taper down to 6, taper down to 4 on the outskirts of that 800-metre radius. I'd almost start looking on those borders in the right established suburbs. But doing your homework, so go and see the consultants first, see a mortgage broker. If you've got an accountant, legal advisors and teams of people that you trust, you'll need them along the journey. The mortgage broker may need your accountant for certain information. The solicitor or conveyancer you'll certainly need to help with contract reviews. You can, once you do have a budget pre-approved, if you've seen a bank or mortgage broker and they've helped you see what you can get approved for, that's really your first step. Because then if you go to a buyer's agent or go to start doing it on your own, your budget's going to guide and determine the types of properties you can afford, the types of suburbs you can afford. And we mentioned before, maybe look at the next suburbs out, see if you can get a better asset if you can't afford a better asset in your first choice. Knowing what types of dwellings, if you can afford a house, I'd always say a house that's well established, robust. Sometimes the brand new ones aren't the better constructed properties. Some of my favourite structures that have stood the test of time, even from like the 1970s, 1980s, 1990s, and a bit of land ratio, and having an investor mindset for long term. After you've built your property buying team around you with consultants, they're usually going to charge you when they actually have to work. So at first, even if you just get a bit of validation through consultations, help them leverage off their experience, their mistakes, their knowledge, right? Because we've all made mistakes through our careers, and seen other people make mistakes that you can benefit from avoiding.
Well, that's part of the good thing about seeing experts, that you've made all the mistakes first for your client. You've been there, done that, so that's another reason why you should talk to someone who's it's their life to be in this sort of game. All right, Mark. Sorry. So there you go. You're talking about first what you should think about when you're buying your first property, how smart buyers win in today's market. Anything else to add?
Well, yes. With as far as mistakes people make is going in without doing the due diligence. So as I said, you other than doing your research in the area, some people buy or start bidding before they get their finance pre-approval. So that's part of that first due diligence I mentioned.
You'd be mad to go to an auction, wouldn't you, and start going, me.
Well, with auctions, you can't bid subject to finance, but certainly some off-market opportunities that get offered, or some private sale, people will make an offer subject to finance, but it can affect your credit rating if you keep getting declined by.
Right.
Is that right, Michael? If you keep buying and then get declined, it can affect your credit rating on the books. If you're buying subject to finance, you don't want to make a habit of that.
No, that's right.
And then also, it doesn't build trust with the agents in the area that you're dealing with. If they, if the deals have fallen through, and then you're going to see them at another property, or generally they're working in a few suburbs, and if that's the hot pocket that you're looking to buy in, you want to establish some good relationships.
Yes.
Forgetting costs of ongoing maintenance and costs of outgoings. That's due diligence that usually solicitors will go over in the pre-purchase review. So people that don't get conveyancers or solicitors to do a pre-purchase review of contracts sometimes don't get, and the mortgage broker will look at those type of expenses as well at a high level, I guess. But buyer's agents will help you go over that as well. But you should look at that for yourself also, and then choosing the right property. So again, well established, a little bit of good land ratio, well located in a suburb. So the risk of going, there was a lot of incentives, and sometimes I say don't go for all the incentives and the tax incentives or benefits, because there's a reason for that, to drive people where they need the growth corridors establishing, right? They're going out further out of the city, but the amenities aren't there yet, and a lot of the infrastructure that was promised hasn't come. So they're struggling to resell, struggling to hold on, and they haven't got the growth that they expected. So coming back into even that 20-kilometre fringe or 30-kilometre fringe of established suburbs with good transport infrastructure, that's really the safer bet long term. Even if you have to push yourself a bit now, as Michael said before, the banks are a lot more responsible with the lending of what you're capable of, even if things turn in your life, compared to say 20 years ago. I was working in sales during the GFC, and we saw a disaster there with irresponsible lending. And then when the economic crisis hits, people that can't hold on, and if they're all flooding to sell at once, then very hard to resell or get equity out of a property. But I think someone's put a question in, but I missed it. I don't know if it was for me or for
I could see that light up there. Could you click on that? Maybe I can see that one. But just as we find that question, so Mark's answered the question there, Michael, about the biggest mistake that he sees from his world. But what about you when it comes to borrowing? Big mistakes that people stumble across when they come and see you?
Yeah, I think with them, it's people just not coming in with an open mind. So if they are making a mistake, it's not coming in with an open mind in terms of what's possible, and realizing that there's lots of different ways, I guess you could say, to use a cliche, to skin a cat, because not every bank is the same. Whilst it may feel like a product is pretty commoditized, it just charges, it's interest, there's an interest rate and a monthly repayment. But there are a lot of nuances within policy of each of the different lenders, and also non-bank lenders as well, that could open up opportunities, and where people think the door's shut for them and then they just walk away thinking it's just not for them. So that's probably the biggest mistake I feel that people make, is just closing their mind off to the options.
And persisting, as you say, keep going back, and there's a way to do it. So that's sort of part of
it. Yeah, that's right. That's right.
Yeah.
I know. Well, Michael's the most persistent. He's good at that, isn't he, Mark?
That's right.
In a good way. That's what you need.
Well
he's
planned,
like, he just gets in there and he keeps going until he finds an option.
Yes.
He's the best.
And I think one of the questions that came through from a guest was, this would go to you, Michael, I feel,
Yeah.
that do you think a uni student studying a health-related degree who has good savings in the bank account, works part-time, and who lives with her parents can be eligible to get a loan and buy an investment property? So
Yeah.
it's a
Yeah.
broader sense, but yeah, you might shed
Yeah.
some light.
Yeah, no, that's a good question. It's a good real life example of where a lot of people are thinking. I mean, same for myself. I've got a daughter who's at uni and works part time as well. And thinking, well, when can she get into the market? What you do here is you break it down. So the good savings in the bank account. So presumably that's then we could use a lot of that for the deposit and potentially combining it if it's no, it's an investment property. So you wouldn't the 5% deposit scheme may not apply, but one of the other schemes might with the that 10% product that one of the new banks had launched. Now, part time, it also depends upon here working part time how much they're earning part time.
Okay.
And the general rule of thumb here is if you're working part in terms of income, how much a lender will lend to you, roughly around say 6 times the level of income that that person's earning. Where it gets a little bit tricky is because it's an investment property, they will take into account that you might qualify for tax deductions for the interest on that property. But again, how much benefit you'd get from that also depends upon the income, because if you're at a lower marginal tax rate, the benefits of the tax deductions aren't as great if you're on a higher marginal rate. For example, if you're on a higher marginal rate, that tax rate, that interest rate effectively is halved because you're getting the benefit of the tax deduction. So
Okay.
that also comes into it. So look, overall, on the face of it, could possibly be eligible for a home loan. And living at home is an advantage because you're not paying rent. Although banks, what they will do though, is attribute a notional rent, but it's definitely a lot lower than what it would be if you were
So
renting it
you're
outside
contributing
well.
to the household somehow.
Yeah,
Okay.
that's right. And usually it's about $150 a week.
That's
Um,
a good. That's a good question, and the answer ties in a little bit to what you referenced before. That the sooner you get in, the better you're going to benefit in retirement. If you're
yes.
getting that growth, if you're capable of buying.
Yeah, that's right.
And in the further part of that same question, that person does have HEX debts as well.
Yes. So that would also come into it. But that said, and this is a bit of a catch-22, depending upon the income level, if it's below that threshold before HEX payments kick in, which I think was around 67,000, actually the HEX debt won't affect it,
Okay.
surprisingly.
Is that where the federal government was offering to wipe part of HEX debts as well? Is that the same incentive, or that's a
I
different?
know well, it's part of that package where they changed up the way that HEX repayments were calculated. And as part of that package as well as eliminating the HEX debt, 20% of it, giving
Okay,
people a discount on the HEX debt. But
it's
yeah, so
better than
it's
a kick in the backside.
yeah, yeah, that's right, that's right. And some people are pretty sizable, not back size, but HEX debts.
Yes, yeah,
I know they can mount up those hex debts, can't
yeah,
they?
Yeah, yeah.
Kieran?
definitely.
Um, all right, some other questions that we need to address to you guys that are coming through. For people who feel overwhelmed and you don't know where to start, we might have touched on this, but the advice to get in there and take the first step. You're feeling overwhelmed, you don't know where to start. What should you do next, guys?
Yeah. Oh, look, Michael, you might want to add to this, but I think part of the people that you want to start speaking to, even if you don't engage them, when I mentioned before, speak to your mortgage broker first or bank. You might get some advice from buyers agents or real estate agents that you trust and know, solicitors, conveyancers. Get a good building inspector lined up for when you need them, because especially if we're talking about Melbourne, most of the options go to auction first. If they're a good property and a property that's going to benefit with growth in time, it should have some competition. That market social proofing, you want that validation. It's going to have it. If no one's buying it or it's struggling to buy in a market that's growing, there might be an issue for it in a tough time if you had to resell. So you certainly want get good quality building inspection of the site as well. And then if it's going to turn into an investment, start consulting some property managers early on. And this is all part of that, getting that team to educate you. It's like an analogy of trying to sail a boat without any sails or without a rudder. The actual team around you helps you guide that, right? And then you make the decision. You make an informed decision, and that's when you buy with confidence. So Michael, you got
Yeah,
anything
you'd agree with
there?
that, I'm sure.
Yeah.
Yeah.
Yeah, I can just quickly add because I know we're running out of time, but really it's just trying to make sure you don't feel overwhelmed by just breaking down all the different steps and maybe working out the numbers first because that's really the
It's
crux of it.
everything.
Is do you have that capacity and capability? Understanding what your strategy is, then the structure, and then the solution, and then the rest will follow.
Yep, yep. Now, Mark, I can see some questions on your screen there
Oh
popping up. I
yes.
just got the numbers there. So as you get your ones, my one here is how early should someone speak to a broker, and should they wait until they're ready to buy? Michael, I guess. Yeah, there you go. How early should you speak to someone like you, and evaluating when you're ready to buy, Michael Sue.
It's never too early because you want to know
Mm.
what you need to do. And some of these things, the gestation period can be, can take 1, 2, 3 years because you've got to plan ahead.
Yeah.
Right.
The savings part, knowing upfront what you need to save for to get to your goal, you got to know you can't just turn up to the auction and then realize, oh, bugger, I didn't save enough. So yeah, the sooner that you start thinking about it, the better.
Mm.
So that it's planning for the longer term,
Yeah.
basically.
I
So it's
like
never
that.
too soon.
Yeah, never too soon. 2, 3
Yeah.
years. I really like hearing that because somebody might think, well, I'm not ready yet, but I want to get. It's mindset, isn't it? Just get your mind into that gear. And I've
Yes.
spoken to you.
Yeah.
I ring up Michael from time to time. He'll tell you just with random sort of questions because it's in my mind, and I want to start to manifest.
Yes.
Do we use that word now? You start
Oh, yeah,
manifesting.
manifesting. Yeah, it's a
Yeah,
buzzword, but
the buzzword.
your planning is very
You are.
important, right?
So you
And it
start.
doesn't cost you money to have a conversation. It costs you
No.
time, but at least some of the things that Michael identified before that he sees, around credit card debt. Now, if that can take time to resolve, but at least someone like a mortgage broker has identified it. It's like working things out in a sandpit before you go out and make mistakes, right? And then and that will I mentioned it earlier. That will determine all the other advice that can come from it. Until you know what you can borrow, it's all hypothetical. It's no point saying calling a real estate agent or a buyer's agent and saying what can I buy for $1 million, but then a few months down the track you work out the mortgage brokers and the banks are able to lend you 600,000. Totally different discussion of how we'd spend that money if you're a first home buyer or investor or any position in life that you're purchasing.
Did you catch those questions on the screen there, Mark? Were you able to access those ones?
Some of them were praise as well, but saying
Oh,
thanks
nice.
and enjoyed the webinar, which was good. But I think if people can feel welcome to get in touch, and get some tips and advice without any obligation. And if it's areas that Michael or I can't assist in, we know plenty of professionals around the country that specialise in different services, different locations that we can put you in touch with.
Yeah, I like the sound of that. So if you've sort of picked up a few points from tonight's webinar and live stream, the next step is to maybe reach out to Mark Errichiello or Michael Sue, ask that first question and start to manifest and start to think about what you can do next. It is exciting, I think, guys. I hear you talk about this, the opportunities, the deposit required, the state and federal governments, different offers from banks, the tips and traps. I mean, it really is there. And I think you said, Michael, about the doom and gloom. And often we hear that and people say, oh, you can't get, it's just not true. It's just not true. If you put your mind in that set, you'll never get anywhere. Have a go and see what you can do. And there's benefits to owning your own home.
It's a good point, Pat. That's perception's reality, isn't it? It's
Yes.
Oh, but it's no, I've enjoyed talking again.
Good.
But, and look forward to seeing your friendly faces soon.
Yeah, that's absolutely. Well, thank you, Michael. Thanks for preparing that. You did all the heavy lifting with your
Good job,
presentation. We can see Michael's contact details there, but also you, Mark. You guys planned it all, and thanks for getting me involved. So thank you to our viewers and for the praise that came online. This video will be made available as well to catch up, and maybe on YouTube or some other platform we'll make it available to you on the social media platforms too. So thanks for watching tonight, our very first web stream, our live stream. I reckon we'll do some more, Michael. What do you reckon? We're all right?
Nice fun.
Yeah, definitely. No, it's been good.
Fun, isn't it?
I've enjoyed it. I've enjoyed it.
Wonderful.
Great hosts.
Yes. Thanks, Pat. Thanks to you.
Thank you to our guests, and thanks for watching tonight on our live stream. Thank you so much.
All right. Thank you. Thanks all. Thank you, Mark. See you, Pat.
Cheers, guys.
See ya.
Bye.
Bye-bye.